As cities expand, people get richer, healthier, and live longer. Rapid urbanization pulls millions out of poverty, pushing living standards higher than ever before. But that rapid growth comes with a steep physical price tag. To build and power these new megacities, we burn through staggering amounts of fossil fuels, flooding the atmosphere with carbon dioxide. You can't just order a factory to shut down or suddenly slash its energy use. If you cut the power, you cut the production. The immediate result of cutting that production is localized economic collapse. Jobs disappear, wages dry up, and regional development stops. In 2009, China pledged to cut its carbon emissions by up to 45% by the year 2020. Hitting that target meant applying a single national goal across 30 distinct provinces. Each of these regions operates almost like its own country, with vastly different levels of wealth, natural resources, and industrial capacity. To meet that pledge without plunging regions back into poverty, the government had to figure out how to decouple economic growth from carbon emissions. They needed a way to pull two different levers at the same time. The first policy lever they pulled was the Carbon Emissions Trading System, or ETS. Under the ETS, the government sets a strict cap on total greenhouse gas emissions. If a company emits less than its limit, it can sell its leftover allowance on the open market for a profit to a company that went over its limit. This chart shows carbon emissions across the 7 pilot provinces. By putting a price on pollution, these regions successfully maintained tight, steady emission lines while their economies grew. This graph maps all 30 provinces over the same decade. Look at these upper climbing lines. Those are regions dependent on heavy, energy-intensive industry. Their emissions kept skyrocketing despite the trading system. For these heavy industry provinces, the financial reward of selling carbon credits is microscopic compared to the massive economic loss they would suffer if they reduced their energy use. Cutting back on coal meant cutting their GDP. You cannot fix a physical dependency on fossil fuels with financial pressure alone. They needed a second lever. That second lever is the sustainable energy strategy, measured in the data as the fossil fuel substitution effect, or SUB. Substitution doesn't mean asking a factory to use less energy. It means replacing the coal powering that factory with hydro, wind, and solar power. This chart details Yunnan province. Over a decade, the orange bars representing their sustainable substitution rate climb from 53 to over 90%. Meanwhile, the dark green carbon emissions line plummets as clean energy reliance rises, all without stalling industrial output. This map shows the substitution rates across the country in 2014. While the western provinces glow green with high sustainable adoption, the heavily urbanized eastern and northern provinces sit in dark gray, trapped by their reliance on traditional fossil fuels. Building sustainable energy infrastructure gives a region an escape hatch. It allows them to maintain their industrial power and economic growth while actively stripping carbon out of their production cycle. When you cross-reference the data, a distinct pattern emerges. The most effective carbon reduction happens when both of these levers are pulled simultaneously. Look at the 2012 map tracking sustainable energy. In the urbanized areas around Beijing and Tianjin, green energy adoption was essentially zero. But in 2013, exactly when the carbon trading pilots began, Tianjin's sustainable energy use jumped to 3.6%. The financial penalties and rewards of the trading system act as a catalyst. When paying for pollution signally threatens a region's bottom line, local governments are forced to actually build the physical infrastructure needed to switch their power grids away from coal. A market-based trading system isn't enough to curb emissions if there's no clean energy to buy, and green infrastructure alone struggles to gain traction without a financial incentive to build it. The policy forces heavy industry's hand through immediate economic pressure, and physical infrastructure provides the viable pathway for that industry to survive. The empirical data proves that deploying both systems together is the blueprint. It allows developing economies to keep growing their GDPs while systematically dismantling their carbon footprint. To explore the regional charts, investigate the data, and read the complete study, visit sherrysue.com. Thanks for watching, and we'll see you next time.